I'm Stephen Galpin and welcome to Property Matters. Today we're going to have a focus on property accounting with Zee Razaq, Managing Director of Surtax Accounting based in St Albans. And we're going to be focusing today on investment in property. Zee, welcome.
Thanks, Stephen, for having us back, and I'm looking forward to the fun that we're going to have today, as you know.
Okay, well, always informative and always innovative ideas, which I like to see. Anyway, Zee, the first thing I'd like you to do, for the benefit of our viewers, can you define investment in accounting terms in relation to property?
Yeah, so property investment companies, in simple meaning is that you own an asset to get rent. So it's investment income. And depending on which structure, if it's a limited company, they call it property investment companies, or if it's your own name, you'll be calling it probably a property investment business.
Okay, right. Okay. Now, does that change any with an individual person? Is there a category for an individual, or is this all about limited companies?
No, there is. So in your own name, we consider investment income, and it's categorized slightly differently, and it's taxed differently as well.
Okay.
To give an example, in your own name, one of the things you don't get, and hopefully whoever the chancellor is not hearing this, is you don't get national insurance. Okay. So when you run a property business, it's really important to look at this, is that you get charged just income tax on your self-assessment return. Whereas if you're running a trading business, like a sole trader, for example, you get charged national insurance as well as income tax.
Okay, so let's go back then to the company situation. We've got, let's say we take a limited company and it's got 10 buy-to-let properties and it has income, right? Now, what decides whether that's an investment company or whether it's a trading company? Because in my mind, I could see both situations being relevant. You could say, well, it's a buy-to-let company, but we have no intention of keeping the assets long-term. The rental is simply a way of holding those properties until we can make a capital gain. Alternatively, you might take the view that we want to keep them forever and a day, and it's the rental income we're looking for. So have I got the two different categories right there?
Sort of. It sometimes becomes a complex matter, but if we simplify it, it's basically when I'm holding property in a limited company, an SPV, fancy name for a limited company that holds property, special purpose vehicle, the whole purpose of it is to get rent from holding an asset. That's an investment company. And if there's certain rules without getting complexity into them at different levels, it can be different things if there's other trades within it. But generally, if you own property to get rent, it'll be a property investment company and you've got to follow investment company rules on taxation. Okay.
And would any trading of those properties, so let's say you got 3 years down the line and you thought 5 of these 10 properties are looking a bit tired, so actually rather than renovate, I think what I'll do is sell them on and let's reinvest in something else. Is there any way that could be deemed as trading as opposed to investment?
Really good question. It depends on how regular the activity is. What's the underlying activity? And you have to do an evaluation because it can become quite complex.
Who does the evaluation? Your accountant or you?
Very good point. Normally someone who specializes in that area, they will do an evaluation and say, look, from what your activities are now, this is probably a development company, so therefore a trading business. So it'll get in a balance. Or you do a group structure and you try to split, demerge the properties because the activities are changing to make sure you can benefit from a tax perspective.
Okay, all right. So we've talked a little bit about the categories. As perhaps a buy-to-let investor, we shall say for the moment, you would then recommend that really that there is more flexibility, there's more value in having those properties in a limited company as opposed to individual name. Yeah.
Really good question. And I know we've had this conversation a few times, but such an important area and it's changing. If we look at the current focus on tax, i.e. where it's going, if you look at what the current nature of the rules coming in is, tax is going to be increasing. So if tax is increasing for limited companies in relation to owning your own name, the decision may change depending on how many assets you hold, and whether you've got mortgage interest or not.
Okay.
And these are the common denominators. So when you're holding property, say one property or two properties, and you're an accidental landlord, which is majority of landlords, it may work in most cases not to have it in a limited company, because you may not have or very little employment income. You've got a couple of properties that are making you some money, so you're in the basic rate band. The tax on interest doesn't apply, and the rate is lower, right? So if you own them in your own name, you're only going to get, if you're a basic rate, 20% income tax.
Yes.
Whereas if you put them in a company and the trajectory of the tax system, how it's going, corporation tax has gone up. Bear in mind, it is for businesses at the current state of affairs if they have more than 50 grand worth of profit. Right. And also personal tax, i.e. dividends, because that's the common way people extract money out, has also gone up. Okay. So you've got to weigh these up and get an evaluation in that sense.
Well, I mean, there's another consideration. I know you're going to say, inconsequential as an accountant, but I'm going to say one shouldn't forget, especially for the smaller investor, that the cost of having a limited company, it is going to be an extra £3,000, £4,000, £5,000 a year in terms of accountancy fees and management fees. And also there could be consequences if you want to shut that company down. It's not that easy these days, is it?
Really good point. Maybe not as much as you mentioned, depending on what activities that you're doing in the business from an accountancy cost perspective, but there's certain things that you're allowed to do in a limited company that you can't do in your personal name. So we've got to always talk about the pros and cons. I'll spend a couple of minutes just mentioning those. In a limited company, obviously you have limited liability, massive. A lot of people forget that, and that's something that you've got to think about. The other thing you have is control on what money you extract out. So you can choose to keep the money within the company and choose when you want to extract it out. And that will reduce personal tax. And the third one, which is so understated, and I fall off the chair every time because people don't understand, is limited companies, whereas in your own name, because that activity in a company allows you to make a pension contribution, which is massive, because if you can invest into your pension from your limited company, that's an expense. And therefore it will reduce how much corporation tax and personal tax you're paying. Whereas when it's in your own name, if it's a property buy-to-let business, I emphasize buy-to-let, you can't make that expense a tax deductible one. No. And that's quite big. It can change a lot of people's decisions, just that last point.
Okay. Just to park your accountant's hat for a minute, and let's just look at the legalities of it. I mean, you did mention there a point that a limited liability company is just that. Now, as property, like most industry, becomes more complex, more prone to legislation and restrictions and rules and regulations, liability can be quite high, not just in financial terms, but in terms of responsibilities. And I think that's a big consideration when you're looking at investments these days in property. Being a landlord today is not easy, especially if you're going to deal in things like HMOs, where you've got a fast turnover of tenants, a high volume of tenants, a lot of regulations that you must adhere to comply with local authority regulations. These are, yes, all costs, which you as an accountant are going to put in the right slots and take the right advantage of in terms of tax allowances. But it's about the legislation and the responsibility, isn't it?
Yeah, and I think there's a question that you asked before, which I didn't cover, is exit, i.e. what happens when you want to close them down, right? There is formalities, a lot of responsibilities. When you've got assets, you probably need a liquidator when you're closing down a limited company because the assets are worth so much. Whereas when it's in your own name, you just sell them and that's it.
Yeah, sure.
And it also subject to different taxes as well. So you're absolutely right, the responsibilities are different. And I was speaking to someone and they said different countries have different requirements to be an owner of a limited company. And for suggesting maybe we need a little bit of some time training, because people don't really understand a limited company has company law and there's certain processes that you have to follow. And they do come a bit unstuck on those things.
Yes. Just mentioning overseas companies, see, is it dead these days to start thinking in terms of owning properties in offshore companies where rather than sell the property ever, you would just sell the bearer shares and transfer them and sort of, I suppose the word is avoid stamp duty in a way.
We never say avoidance anymore. It's called tax planning.
Right.
Regarding shares, shares have different rules. They're subject to stamp duty, which is at 0.5%, whereas when you sell the asset, i.e. a property, is subject to stamp duty land tax. And that can vary, as we had discussed in previous episodes. Whether you have it in a company, offshore or onshore, the advantages have diminished. And the reason being is that legislation happened in 2015 for properties that were residential, non-resident landlord tax, which people will be aware of. And another thing, in 2019, they got rid of commercial property as well, having a benefit. So now, because of withholding tax, it's not that beneficial generally to hold a portfolio offshore and the implications to it. And there used to be a lot of benefits around inheritance tax and things like this. But because of the withholding tax, this is causing a lot of people problems. Whereas if you've got a development business, it's a trading business, and you may have indication of people going abroad because there's different implications. But they've covered off investment businesses for that kind of strategy these days.
Okay, cool. Well, that's all we've got time for in the first half of the show, so join me again after the break when we'll be asking Zee Razaq more about tax. Hello and welcome back to part 2 of Property Matters. I'm Stephen Galpin. I'm with Zee Razaq, Managing Director of Surtax Accounting, based there in St Albans. Well, we've brought you into London today, so nice day out for you.
Lovely day out. We even brought the team, as you know, as well.
Good. Okay, Zee, we were just talking about sort of matters offshore, and one of the hot subjects that we've had over the last couple of years is this business of overseas individuals owning property, particularly in London, using offshore companies to hold it. No responsibility for tax in this country, very difficult to chase if anything goes wrong. And it's always occurred to me that and I'm surprised it's never really been brought in properly, the idea of having a responsible party looking after your interests as an obligation in the country that you're in. So in other words, if you're an overseas person, you buy a property in London, you've got to have either a certified accountant or a registered solicitor or somebody looking after and making sure you comply with regulations in terms of payments of council tax, obligations in terms of tax if there's rental income, that sort of thing. Are you too surprised that it's never really been?
I think it has been slightly addressed, but could it be more? Potentially. I think the challenge we find is that until recently, HMRC have had quite a lot on their plate, and I think they've got a few things still on their plate as we speak. But I think the biggest challenge we're going to have is when we're talking to entrepreneurs, right, is making sure they understand the governance. And the challenge we have when they're offshore is that you have two facets to it. You have the UK regulations and the regulations of their country that they've, and this is the challenge. And then it depends on the double taxation treaties. So it's a complex area because if I was looking at property development, let's look at that for a second. If you have property development and are based in Dubai, it's quite advantageous depending how I structure it out there. If I've got a property investment company and I'm based in Dubai, less advantageous because there's withholding tax. So this is where the challenge comes. And you mentioned about regular compliance to council tax and the other aspects. Surely as a business owner, wherever you're based, you should be liable. So the council should be able to challenge you to understand that.
But they've got to get hold of the person to challenge, haven't they? That's the issue.
They do, but if they were coordinated with Company House, for example, because the company would have to be potentially registered in the UK if it's a UK limited company. I guess if it's an overseas company, it does come down to when the company's set up. The challenge really becomes is where companies are located offshore and they own UK property. And that is more difficult, as you mentioned. So what's happening at the time of purchase, there is become more requirements, especially from a legal perspective, because they have to do the conveyancing around registering and making sure they're registered correctly. The problem comes is whether they've got tax or accounting agents in the UK as well as abroad. Because if they don't have them in the UK, then they may not follow all the UK formalities, whether it's on purpose or accidentally. I think that's the big challenge.
I think one of the reasons I sort of brought the question up, Zee, is because looking at one of the headlines in the property press this week, agents are being criticised for not complying with money laundering regulations and are not really fulfilling their duty to inform revenue or the authorities of anything untoward that they see, which they do have now a legal obligation to do, I believe, under the regulations. But of course the question arises, you know, go into a firm of estate agents, there will be some senior and well qualified negotiators and property managers there, but there'll also be a lot of young people who are just starting out in the industry who are not going to be au fait with money laundering regulations and what to look for and what not to look for. And we've even seen television programs where you know, obviously somebody from a particular country that perhaps has a reputation for black money and, you know, property ownership in London when they shouldn't have property ownership in London. These kids are not able to really simulate that and work it out. And that's why, again, I think there has to be some key legislation about what to register, when to register it. And it sounds from what you say that since 2015 it's gradually getting better, but I think we can go a bit further.
I agree. I think the solicitors have a lot more onus because the AML stuff they do, and if any UK accountancy tax firm is looking at clients, they've also got obligatory requirements as well. So there is that facets there which haven't historically probably been there, but post 9/11 and things like this, the ID verifying has become huge.
Mm-hmm. Okay, well, look, so we've gone through investments and trading, we've gone through how to set it up, we've gone through perhaps some of the regulations we need to adhere to own our properties and own our companies. Let's go to the other end of the scale now and talk about exits, because exits is always a difficult subject. I know at one time we had a very easy rule about exiting a limited company. You could take, was it called entrepreneurs relief? I think you could take your money out at a relatively low tax rate after you'd had a successful company for a certain period of time. But I think all that's changed now too, hasn't it?
I think that's been changed for a while, where if you're not a trading business, i.e. a property development or an accountancy practice or something like this, you're not going to be able to get entrepreneurs relief. I have to caveat this because I'm sure people on different platforms will be saying, that's not the name anymore, it's business asset disposal relief, which is a tongue twister. But we all know it's entrepreneurs relief. Just to clarify, that's what we mean. So that's definitely gone as one of the exits. But what's happened now is if you've got an investment company, the advice has become so crucial, more than ever before, because at the time you create the company or when you become aware, I have to emphasize that because some people are not aware, is you have to have your exit strategy. And I put investment companies into 3 types of exit strategies, and hopefully I can just probably expand on it. Yeah. The first part is probably my favorite solution, is something called a family investment company, where you got the dad, the mum, and then you've got the children who tend to be below 18 in have certain type of shares that are in a discretionary trust. So the parents keep the control and the earnings, but their shares are frozen, as in the value, and all the growth goes in the children. That's legacy planning. In order to do that, you need an accountant, a tax advisor, a lawyer, and a good reputable finance broker, because there's quite a few implications. But that is a really good way of doing it.
But quite a high cost, I would think, in administering that scheme.
Well, not administering, but the setup. Because administering it, we company accounts, as long as the person's a property accountant, tax advisor, they will understand what to do the formalities on an annual basis. There may be a bit more on the trust because the rules have just recently changed, but generally it's just the setup cost so important, and that's where people weigh it up. The second bit is that you basically pass your shares over as you become more older and your business is scaled and you're like, now I want to pass the legacy over. That's a problem. Because unlike trading businesses, when you do shares in your investment company and pass them over, you don't get gift relief. And people are like, what are you talking about, Zee? If I give the shares to my child it's going to be subject to capital gains tax.
Right. And how's the value of those shares assessed? Is that just based
Correct.
on the last year's accounts?
The value at the time of disposal. So you need someone to value your business. So important. So that's the dynamics of when you're actually selling them. You must get a valuation for property, and it's got some fun rules in there, like indexation still applies depending on your circumstances and things like this, from how long you've had the property, but also how you own the assets, less the debt and all the rest of it. So just taking the book value probably isn't the best way of doing that.
Right, okay, got it. And so they're the 2 or 3 sort of standard exit sort of strategies.
Sorry, one more. The
Yeah.
last one is do nothing, which I never mentioned.
Okay,
That is quite a popular one, right? So you've got 3. 1, the family investments. Number 2, a bit of, I'll pass them along and you have to be really careful. And number 3, I do nothing.
Just wing it. Yeah.
I'll put my head in the sand. So sorry to interrupt. I think that's what the normal entrepreneurs thinking about, and they need to really advise what's the right one for them.
But again, life has become so complex today. Laws have become so complex. Tax regulations are very complex. It's very important not only to strategize your way in, but this way out is so important, isn't it? And you know, if you mess it up, there's no going back, is there? That's the problem.
And this is what happens with a lot of entrepreneurs, right? They start the journey. They haven't even planned the journey on an annual basis, how it's going to look like, how extract money, which we were talking about earlier in the show, very important as well. Then they get to a point, oh, I've got all this asset, I've got big inheritance tax issue here, I can't pass it to someone because I've got capital gains tax on the shares. Then they're like, oh, how do I do this? So we protect against the future growth, but then you've got to be really clear of what's already been accumulated in the parent's name and how you can potentially plan for that. That's much harder, and as you rightly said, it should be done at the beginning if possible, because during the process you've already accumulated some skin in the game that you maybe didn't want to.
Yeah, okay, I understand. Look, Zee, all of this is a little bit above my head, but it's very informative. I love the way you put it over, because it starts to make it understandable, and that's a very important a very important matter to come to terms with when you are talking to accountants and professional advisors of any kind. I think is whether you can engage and whether you can really understand what's going on. Now, sometimes we are humans and we do make mistakes, and sometimes we fall out with revenue about our opinion of various things. And the final question I've got for you is one that we have often coming into us through another one of our shows, Question Time, for instance, is that people ask, I'm being offered by my accountants insurance that will allow me to cover the cost of any inquiries or disputes or whatever comes up with revenue, which can be awfully expensive, can't they? Because revenue will tend to go back and back and back, and historic information is by nature expensive to dig out. Is that a course of action you'd recommend for the sort of lesser informed person?
I think for every, whether informed or not informed, we make it a standard at my business and many accountancy tax advisory practice to have what we call tax investigation, protection fee, called loads of different names, but ultimately it's insurance against if HMRC come and investigate you. You have to caveat this, and I do always say this to any people that we have dialogue with, it's provided you're doing everything properly. Because if you're not doing it properly, the insurance is not going to help you.
It's going to be void, isn't it?
It's just like your car insurance, right? If you don't tell them everything on your car and then you have an accident, are you covered? Yeah. And this is the same for this type of insurance. And we are big advocates because we've had investigation of HMRC for some clients which didn't even make sense. My only challenge back to HMRC is when they've clearly made an error, what is the compensation to the accountancy practice, which is how to claim on its insurance to defend the client who's done nothing wrong? No, nothing.
The answer is nothing, isn't it?
And the cost to the taxpayer for HMRC to do an investigation. So there should be a process and some compensation, I believe, because it's got to be a fair system. And I'm quite passionate about this because I don't think it's always so fair. Anyone who's not doing things correctly, I think HMRC should, because that ruins it for all the people that are. But it's quite a lot.
But Zee, you're an experienced man, and I think, you know, life ain't always fair.
it is true. You don't always get the cigar at the end, yeah.
All right. Zee, once again, thank you so much for coming in. Your explanations have been really understandable on very complex problems in a way. But I really think the message is, you know, again, check with your professionals, make sure your strategy is right, and make sure it's a tested strategy. So if you'll agree with me on that, we'll say goodbye to our viewers. Thank you very much for watching, and I look forward to seeing you next time on Property Matters.